That's absolutely asinine, and you know it. It's ridiculous.
I'm choosing the 50-year. I'm choosing it all day long.
50-year mortgage loan? Are we crazy? Is everybody okay? No, nobody is okay.
It's not even a big deal. I mean, you know, you go from 40 to 50 years. All it means is you pay less per month. You pay it over a longer period of time.
Late last year, US President Trump caused a media frenzy when he floated the idea that the government should back the creation of a 50-year fixed mortgage. And in a rare showing of bipartisan agreement, people hated the idea.
And this is going to fix America's housing crisis. Oh, horse crap, Trump.
Simply put, math isn't mathing.
Financial engineering.
You know where we'll all be in 50 years? Dead. You know what I
mean? This proposal makes absolutely no sense at all.
But wait a minute, stop here for a second. Is a 50-year mortgage really such a crazy idea after all? Many other countries around the globe, from Japan to France, Finland to Sweden, offer long-term mortgages with terms up to 50 or even 60 years long. And in Switzerland, you may never pay your mortgage off because it's financially advantageous not to do so. So how do they do it? Why do they do it? And at the end of the day, is a 50-year mortgage stupid or smart? Let's take a look. But before we deep dive into the 50-year mortgage and what it all means, it's important that we can understand and compare it to the standard mortgage that most of you are likely familiar with. An overwhelming majority of U.S. home buyers, about 90%, choose a 30-year fixed-rate mortgage, making it far and away the most popular mortgage term in the country. It is quite literally the engine that drives U.S. home ownership and the ubiquity of the American dream across the nation. By locking in the principal and interest portion of the payment over a long period of time, it is stable and flexible regardless of inflation or interest risk. Plus, it's typically prepayable without a penalty, and when mortgage rates fall, you can always refinance and lock in an even lower monthly payment over the remaining life of the loan. And the financial market loves it too. Fannie Mae and Freddie Mac buy up 30-year mortgages, bundle them into securities that they then guarantee, and then sell those on to investors, reducing long-term risk. But while the 30-year term home loan is by far and away the juggernaut of home financing, it didn't always used to be this way. For pretty much the first 150 years of the United States, you either literally built your own home on your own land or you didn't own a home at all. You rented. Sure, there are exceptions, like with everything, but mass individual home ownership is a relatively new phenomenon. Early mortgages often required a 50% down payment with just a 5 or 6 year term and a balloon payment at the end. Which is why, from 1890, when the US Census began tracking this data, to 1930, the home ownership rate remained relatively flat, hovering around 46.5% despite the economic growth of the Roaring '20s. But then there was the Great Depression. Banks failed, borrowing dried up, and about 50% of the mortgages were in default, and about 25% were en route to foreclosure. So as part of the New Deal, the Roosevelt administration established the Home Owners Loan Corporation, ultimately leading to the 30-year fixed-rate mortgage that we have today, which revolutionized homeownership. Even if mortgage rates increased, even if there was a depression or a recession, you could go on paying your mortgage because that rate wasn't going to go up. Which, when you put home mortgages into an international context, the 30-year fixed rate is really, really quite unique. And quite frankly, this might be a hard pill for most Americans to swallow, but if it wasn't for the government subsidizing your housing, many wouldn't be able to afford it. And no, I'm not talking about Section 8 or low-income housing, I'm talking about you, the single-family homeowners. Without Fannie Mae or Freddie Mac and ultimately the US taxpayers backing a 30-year fixed-rate mortgage, investors really honestly wouldn't take on the long-term risk of buying them in the form of mortgage-backed securities. Some economists argue that we'd be better off fully privatizing Fannie and Freddie and weaning the mortgage market off government guarantees entirely, which is something the Trump administration has floated in recent weeks. But if we did so, it would probably kill off the 30-year fixed-rate mortgage. The private sector would likely migrate towards a 20-year loan with a 7-year arm, which is somewhat similar to how it's done here in Germany, who has a national home ownership rate pretty similar to what the US had before the 30-year fixed rate came into play. By and large, this is what government subsidized housing looks like in the United States. Not this. But nonetheless, there are some pretty clear benefits of the unicorn mortgage system that we have in the United States. One is lower monthly payments because homebuyers can pay off their loans over 30 years. Another is homebuyers are given an incredible ability to freeze their housing costs in stone and then refinance when it suits them. If the US was to start introducing a 50-year mortgage and extending that freezability as it has been proposed, how would it compare to a 30-year mortgage? Well, let's take the median US home as an example. With a purchase price of $410,800, and after a 20% down payment, so we don't have to pay PMI, you would be left with a mortgage payment of $2,023.49 on a 30-year fixed-rate mortgage of 6.25%, which is what is currently tracking at the time of filming. However, this also means that although you only initially financed $328,640, over the course of 30 years, you would have paid an additional $399,817 in interest, meaning the total cost that you paid for that house was $728,457. Now, compare that to purchasing that same house for that same amount of money at that same interest rate with the same down payment, but extending the term of the loan over 50 years. Your monthly payment would fall to $1,788, a savings of $250 a month, or about 12% of the cost. Which, yes, just as a quick caveat, this calculation is presuming a bank would not require a higher interest rate on a 50-year mortgage due to the duration of the loan. However, the longer term of financing means that with a 6.25% interest rate, you would have to pay an additional $744,160 in interest payments. And the total cost you paid for that house is now $1,072,800. Just to frame this another way, as if it wasn't shocking enough, you pay about $344,000 more in interest over the life of the loan. That's almost the price of another house. But buyer beware, as the 2008 financial crisis illustrated, if the housing market gets dicey, you can and almost certainly will be underwater very quickly. A 50-year fixed-rate mortgage means that you don't build equity very quickly. So if there is a recession and the value of your house drops, you can all too easily find yourself in a situation where you owe more on your house than what it is worth. Which, yes, all of this means that a 50-year mortgage feels very stupid and not smart. But hear me out. Most homeowners with a 30-year or 50-year loan aren't going to pay it back. The reality is that most homeowners ditch their mortgage well before its end date. In the United States, unlike some other countries, including the United Kingdom, you can't take your mortgage with you if you sell your house. So when people sell their house and move, they end their mortgages. And Americans move a lot. The typical American homeowner spends less than 12 years in their home, according to Redfin analysis in the US Census data. That's actually pretty high compared to recent history. Back in the early 2000s, Americans typically spent only about 7 years in their houses. And that is very different than in many other nations around the globe. The Germans, for example, tend to acquire properties later in life and then stay in them, rather than constantly climbing the property ladder. One study found that on average, Germans work on paying off their home for about 22.3 years. But all of this is to say, in all likelihood, the 50-year mortgage would not be a 50-year trap for most people who would take one on. Obviously, somebody who takes out a 50-year mortgage at the age of 35 shouldn't be still paying off massive debt at the age of 85. But what it could basically serve as is another option on the menu for homebuyers looking to finance their houses. And because you have longer to pay off the loan, it comes with the benefit of having somewhat lower monthly payments. If interest rates are high, maybe you go the 50-year route and play the market. Wait until the rates come back down, you climb the career ladder and then refinance with a shorter term. And in the meantime, you can use those cost savings to invest in higher yield investments. I mean, sure, you're gambling on things going well in life, but there could arise a scenario where a 50-year mortgage makes sense temporarily. However, keep in mind that while the president is floating the idea, he alone does not have the power to make it happen. Under the Dodd-Frank Act, the mortgage giants Fannie Mae and Freddie Mac cannot insure a mortgage that is longer than 30 years. So any 50-year mortgage would be considered a non-qualifying mortgage and would be way more difficult to sell to investors. Congress would have to amend U.S. financial laws in multiple places to allow for a 50-year mortgage to happen, and there appears to be little appetite for Congress to take this on immediately. The 50-year mortgage certainly makes for tantalizing headlines and viral social media moments. But as I researched for this video, it was astounding at how political and polarizing the media coverage was, with little critical discussion of the positives or the negatives. That's why I always use our sponsor, Ground News, because it gives me an easy, data-driven, objective way to read the news. On Ground News, every story comes with a quick visual breakdown of political bias, factuality, and the ownership of sources reporting, all backed by ratings from 3 independent news monitoring organizations. When news coverage first broke on the Trump administration's discussion around a 50-year mortgage, the story and very opinionated reactions to it caught on like wildfire, with 240 news sources reporting. To separate fact from fiction, I've been using their new headline comparison feature to see specific differences in left-right reporting. For this story, a left-leaning outlet insinuates that there are more drawbacks than benefits, not only covering the litany of potential risks to such a long-term product, but also ending the article with Trump's perceived lack of concern over the criticism or technical aspects of the idea, while a right-leaning outlet acknowledges the criticisms of the plan, but instead takes a decidedly supportive spin, highlighting the plan as a, quote, game changer. If one side of the political spectrum is ignoring the story, the blind spot feed will let you know so you can make up your own mind about how reliable the reporting is, which is a level of transparency that I very much appreciate when I am sifting through the data and reports on each subject I cover right here on my channel. So go head over to ground.news/Ashton to check it out, or click the link down below in the description of this video or scan the QR code on your screen. You can subscribe through my link to get 40% off the Vantage subscription, the same plan that I use, which includes unlimited access to all of their amazing features. Plus, when you subscribe, you not only support me, you're also supporting an independent platform trying to make the news more transparent. But it is worth asking, if there are all of these pitfalls and risks for longer-term mortgages, why is it common elsewhere around the globe? Well, like anything, the answer depends on the country you are examining because, of course, no two countries are alike, and by proxy, no two financial and tax environments are alike. But let's compare longer than 30-year mortgages in 2 countries, and just to illustrate how those things can work. Here in Germany, where I own a home, we experience extraordinarily chronic high housing costs, high construction expenses, and substantial closing costs, which makes longer-term financing pretty much a necessity for most buyers. So one of the strategies that they use to increase affordability is to offer you financing for the length of time you have until retirement. Germany's standard retirement age is 67, so if you're 30 years old when you buy the house, you could get an offer from a bank for a mortgage with a term of up to 37 years. But keep in mind, you aren't going to have a fixed rate for 37 years. Instead, banks here typically offer a 10-year ARM, maybe a 15 or 20 in exceptional circumstances. According to Deutsche Bank, since 2015, fixed rates of 10 years account for almost half of all new contracts. But private mortgages are almost only going to guarantee mortgage rates for a short period of time. Just like any industry, banks want to make money too. And it isn't likely viable for a private bank without the government backing a loan to offer a 30-year fixed rate product. Now, As a small caveat, because I anticipate this, Germany does have the Kreditanstalt für Wiederaufbau, or the KfW, which is a state-owned development bank that offers subsidized loans and grants for things like buying a primary residence or building energy-efficient homes. But these loans aren't usually covering the entire cost of a home. But Germany is a good baseline example because, yes, while you can have longer than 30-year mortgages, like most countries, they're still designed so that the debt is paid off at some point. Unless, of course, you're in Switzerland, where the principle of deferred debt is still very common. Here, most people will not reimburse more than 35% of the house value, and they'll keep that mortgage for life. So how does this work exactly? Well, fair warning, this is a very surface-level explanation because you could be here for hours going into the different pillars of investments and amortization types, but in general, to buy a home in Switzerland, people need to be able to pay 20% of the purchase price up front with their own funds. At least 50% of this needs to be in cash. The other can come from retirement or collateral. But the remaining 80% of the home value is going to be financed by the bank through a mortgage. But unlike in the United States, where you have kind of one homogeneous home loan from your bank, in Switzerland, mortgages are typically divided into two parts. The first part, up to 65% of the property value, doesn't necessarily have to be paid back, and I'll explain more about that in a second, so pause there for a moment. While the second part, this 15%, must generally be amortized within 15 years or by the time the borrower reaches retirement age, whichever comes first. So in other words, every year you'll pay 1% of the value of the mortgage. Important, this money gets removed from the loan. As such, the interest you pay yearly will decrease over the first 15 years. But to explain with greater detail, let's do a quick hypothetical. Let's say you want to buy a house which costs 1 million Swiss francs. And by house, I mean a modest apartment in Lucerne. Every bank, again, is going to ask for a minimum 20% as a down payment. So your new mortgage is 80%. So 800,000 Swiss francs. We have, again, two parts to this mortgage. Part one is 65% of 1 million, so 650K. And part two is the rest of the 15% left, so 150K. If we amortize over 15 years, like I spoke about, then your breakdown is going to look a little bit something like this. And your total approximate monthly payment would be 1,874 Swiss francs per month. Plus, of course, other things like maintenance, insurance, taxes. But again, I'm just talking about the mortgage part here, which, don't get me wrong, is not an insignificant amount of money. But if using this strategy, a 1 million Swiss franc property has roughly the same monthly payment adjusting for currency exchange of a $500,000 property in the US on a 30-year mortgage. But investing in a more expensive property isn't the only advantage of this system. This isn't why they do it. At the federal level, effective debt interest can be deducted up to 50,000 Swiss francs per year. So in the example that I just gave, all of that interest that I paid on that 1 million Swiss franc property is a yearly tax deduction. In addition, Switzerland is one of the few remaining countries that makes residents pay a wealth tax on their assets every single year. It's not a massive tax, but you are kind of sort of incentivized to never pay off your mortgage because outstanding debt you owe offsets your assets. And keep in mind, mortgages in Switzerland are extremely cheap by international standards and have been for years. At the time of filming, a 10-year fixed-rate mortgage is available for about 1.7%, while 3-year mortgages can even be obtained for under 1%. By comparison, in the US, the average mortgage rate is roughly 6.5%. In Germany, a 10-year fixed-rate mortgage is currently available for around 3.6%, and in the UK, the cheapest 10-year mortgages stand at just over 4.4%. The main reason for the low mortgage interest rates in Switzerland is, of course, the monetary policy of the Swiss National Bank. The Swiss franc, traditionally considered to be a safe haven global currency, has appreciated against all major world currencies in recent decades. Plus, Switzerland has experienced comparatively low inflation. It's cheap money, as they say. And so in Switzerland, having a mortgage for 50 years isn't stupid. It's smart if you can afford it, because to be fair, things aren't all rosy here either. Property prices in Switzerland are breathtakingly high. In the last 8 years alone, the value of houses and flats has increased by over 30%, and as a result, just 20% of the population can afford to own a home. In the canton of Zurich, this figure is below 10%. And just as a quick comparison, the median home price in the United States is $410,800, while the median Swiss home is 1,379,868 Swiss francs. That's over 4 times as expensive. Switzerland has, by far, the highest per capita debt in the world because primarily of mortgages. And so the high prices also put the people at greater risk of being unable to afford their mortgages after retirement, which is a fair concern. So my final 2 cents. Is a 50-year mortgage stupid or smart? Well, if your plan is to only use it as a 50-year fixed-rate mortgage, for most people, this isn't a smart move unless you intend on refinancing and using the limited cost savings to make other investments. My main concern is that it appears the Trump administration is floating 2 contradictory things at the same time when it comes to housing affordability. On the one hand, he's indicated he wants banks to offer a 50-year fixed-rate mortgage to lower monthly payments. On the other, he stated he thinks the government should re-privatize Fannie Mae and Freddie Mac. This would likely increase mortgage rates, and as I've said before, private lenders would be adverse to taking on the risk associated with even a 30-year mortgage, let alone a 50-year one. But can a 50-year or 99-year mortgage be smart if you live in a country where you can use debt to shield your assets or defer tax? Yeah, but I would love to hear how things are in your neck of the woods. As I mentioned in this video, no 2 countries are the same when it comes to mortgages, so let me know how things go where you live and what do you think? Is a 50-year mortgage stupid or smart? And would you do it? And as always, if you enjoyed what you saw today, be sure to hit that thumbs up button. And for more content from Type Ashton, hit that subscribe button. So, I'll see you in the next video. Cheers!